This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. Today we went a little long. Sorry about that.
You got your factor fill off your chest.
Yeah, we talked about a bunch of stuff, and then we talked about other factors, or how far can you push the evidence?
But these are questions that are coming up, so we had to get into it. Apologies to those who are kind of had enough of us talking about factors. Maybe we'll take a factor hiatus for a few weeks.
We have taken a factor hiatus. This is the first time in a while that we've really dug into factors.
But we did cover other interesting things like increasing CPP benefits. We talked about
Advocis not representing us.
Our regulatory bodies and the debate going on there. I think the big news around Vanguard, I think, is pretty cool. Coming potentially, we don't know. This is a rumor coming to Canada with their advisor services. So it was a fun debate. I think it's a good conversation here. So people learn something.
An extra 10 minutes, so you can
extra 10 minutes here.
Listen to the rest on the way home. I don't know.
Talk about factors.
All right, enjoy the episode. Welcome to episode 24 of the Rational Reminder Podcast. We have a whole bunch of stuff to talk about today. We've had a bunch of interviews, so Cameron and I haven't had a chance to cover a bunch of topics that we've wanted to cover. We're going to start off with several topics, and then we do have one kind of big topic that we want to chew on, which is, I don't know how you describe it.
But you're dying to get to it.
Well, I am, yeah. But it's like other factors, or like evidence that dimensional doesn't follow is kind of how I would summarize that section.
Yeah, and what evidence to follow and what evidence not to follow. Yeah, these are good questions and how you make those choices.
So we're going to get there. But before we do get there, we wanted to talk about CPP. So CPP is expanding starting in 2019, which is going to affect everybody in Canada that earns a salary income. As of right now, so the old CPP, as of 2018, I guess, and prior years, it's been designed to cover in retirement 25% of your income up to a yearly maximum amount. So that's called the yearly maximum pensionable earnings. And it's what, around $57,000 this year?
Around that, yes. So I think the maximum CPP benefit,
it's around $1,300 a month.
Correct. That's the average. I think average maximum is paid out, but I think you can earn up to $13,000 per year, right?
Yeah, it's $1,300 a month-ish is the maximum benefit.
Yeah. But so the average benefit is around $13,000 a year. That's it.
Sure, makes sense. And most Canadians get like 60% of the maximum.
And you contribute 4.95% of your salary, and your employer matches that.
Yep.
So call it roughly 10% of your salary now is what's being saved to get you that $13,000 per year.
Yeah, but most people don't get the max because you have to work for 40 years earning the yearly maximum pensionable earnings in order to get the maximum benefit. And usually people either don't earn enough, they don't earn the 55 or 57,000 or whatever in today's dollars every year, or if they're earning way more than that, for example, they might not work for the full 40 years.
So do you think this is a good idea, a good move?
Well, so we haven't even talked about what's happening. They're making it bigger, but the way that they're doing it is they're doing two things. So they're increasing the amount that you have to contribute. So it's going up from 4.95% to 5.95% by 2023. So they're taking a few years starting in 2019 to roll that out. So the increased contribution, and they're also making a second tier. So when your income gets above the yearly maximum pensionable earnings and then up to a new limit, you'll also have to contribute an additional 4% of your income. So it's 5.95% on the yearly maximum pensionable earnings, and then another 4% on this next tranche of income. And then obviously the overall benefit is going to increase. So the goal is to have 33% of your yearly maximum pensionable earnings, but they're also increasing your yearly maximum pensionable earnings.
Right.
So the overall CPP benefit will be substantially larger for people, but it won't really affect people until retirement as of, I think it said 2065 in the article that I read.
Yeah, they're targeting to be about $20,000 per year in today's dollars of benefit. So roughly 50% higher of benefit.
Yeah.
So that's meaningful money.
It's a good thing. There was another study that we don't have slated to talk about it today, but there was another study, or not a study, a survey, I guess, talking about how the savings rate of Canadians is the lowest now as it's been in, I don't know, some number of years.
So this is good for savings. It's a well-diversified program. You have pooling of people going on, which gives you more safety. That to me is the real benefit. I mean, it gives you some fixed income for life, but you do not have to worry about managing it. You live a long time, you're protected.
The biggest thing, the biggest benefit of this, because say with like CPPIB, the CPP investment board, I'm sure they do an okay job. They've been slammed a little bit over the last few years for having high overall costs and stuff like that, but I'm sure they do fine. But that's not the selling point. The selling point is the mortality pooling.
Absolutely.
So if it's like, well, the downside is if you die early, then you lose out on the contributions that you made to CPP. But the plus side is that if you live longer, then you have this income for life. Now, most people don't do that. Like most people won't buy an annuity. An annuity is a very similar thing. Like if you die early, your effective rate of return is very low or maybe even negative. But if you live for a long time, it's great. But no one wants to buy that because you lock your money up and all this other stuff. But if you're forced to buy it, I think it's pretty good.
Yep,
Ultimately, it's pretty good.
This is a good move.
Yeah. Good move overall. Another thing that we want to talk about before we get into the main topic is Advocis, which is the industry lobby group. I don't think they represent us though. We're not members.
No, we're not.
I wouldn't consider Advocis to represent me. I don't know how you feel about that.
No, it's okay.
It's okay. So Dennis Tew, who's the head of national sales at Franklin Templeton Investments Canada, which I think they've actually had. I was looking at asset flows yesterday for our later conversation in this episode, but I think Franklin Templeton has been bleeding assets, if I remember correctly.
That would not be surprising.
Big negative outflows.
I mean, we used to use their funds extensively back in the mid-90s. Haven't used any of them since then.
Classic high-fee active manager. Anyway, so this guy, head of national sales, he was speaking at an Advocis symposium, and he said, quote, "They, the CSA, have thrown in this last round of reforms with very little thought put into the business consequences of what they are suggesting." Now, it's true. Financial advice is a business, as everything else is. I mean, even dentists and things like that, they're still businesses. But I don't know how you feel, Cameron. I always take a little bit of issue when lobby groups like Advocis put the business interests of financial advisors before clients.
Well, they're basically saying that there's no business here that people will not get served. So if you're doing things that impact the business, there's less service to go around. I think that's their basic argument.
Yeah. So I've got another quote from him. "There's an overall focus on cost being the most important suitability requirement, but lowest cost doesn't always mean better outcomes. We think that any focus in this area that reduces the number of investment service providers in the industry or the investments offered to clients is reducing competition, and that is always bad news for consumers. Anytime you have less choice and restricted access, that's bad for clients." I disagree completely.
It's a shock to any listener.
Fundamentally, he's right. Like if we're talking about business in general, yes, it is true that when you take away competition, that is not good for the end client. But when we're talking about the competition being between a bunch of firms who are selling high-fee mutual funds to earn big commissions, I mean, in no way, no matter how much competition you have, is that going to be the best thing for the client.
Right. And why does it always have to be wrapped up in these active mutual funds? That I don't understand. Like, I'd love to know how much of I guess we know by looking at the overall data of the mutual fund landscape, but how much of it is invested in low-fee index funds of those Advocis members?
I bet you it's zero. That's an exaggeration.
The number's pretty small regardless. So like, why can't you just, you can cut the MER in half, the expense ratio in half, just in going from active to, index mutual funds? I mean, that's a start right there. It doesn't change your advisor comp whatsoever. Why does it have to be wrapped up into we're picking better funds? I never understood that.
Yeah. I mean, we pre-recorded an episode with Robin Powell that'll air in January today, but we talked about this, and he made a really interesting observation about the UK, where they've actually banned embedded commissions altogether. And what has happened is that the financial advisors who were selling these commission-based fund products, they've continued to recommend actively managed funds from the same companies because they had close relationships with those fund companies. Right. So it's like you've been recommending Franklin Templeton for years. If you're taking off commissions, you're still going to do the same thing because that's what you know.
I was shocked when he told us that.
Yeah, it was very interesting. But you got to think about it, right? Like our heads are so deep into indexing and dimensional.
But I remember back when we converted because we used to have a mutual fund dealership here. We went from a mutual fund dealership using Templeton and all these other brand name funds in the mid-90s. And as soon as we went fee-based, it was just automatic. Once you start looking at what is available in the marketplace, we all became indexers here. And then once you get in the index world, it's all about how do you improve those portfolios from there, which led us on to discovering factors and dimensional and everything else. I don't understand how you stay with the same providers. I don't get it.
I don't understand either. Anyway, it's the whole idea that taking away embedded commissions is going to be bad for the end client. That's almost disgusting to me to say that, to make a statement like that. You think about stuff that's out there now, like Wealthsimple, which maybe they don't offer the best face-to-face, in-person, one-on-one advice, but then you've got people out there like Rob Engen, the Boomer and Echo blogger that we had on a while ago, And there's tons of other ones now. There are tons of fee-only, $400 an hour or whatever they charge financial planners. So you pair that up with robo-advisors or with the new Vanguard balance
decision
funds.
ETFs, one decision funds.
There is no place for high-fee mutual funds, none. And the idea that taking those away is going to be bad for clients, I think it's not
and
something.
Then, look at Vanguard's announcement. Was it an announcement or a rumor this week?
It is a rumor. It is not an announcement. I actually reached out to Vanguard and their media person responded saying that they could not discuss future business strategies and they would not give me an expected date because I asked if they would come on the podcast to talk about it. And he wouldn't even, wouldn't say that.
This is potentially a big deal.
I don't think it is. It's not a big deal to us.
Not to us, but I'm saying to the marketplace.
It's a big deal to Wealthsimple. It's a big deal to RBC's new Investees service.
So what is it?
Well, Vanguard has their personal advisor service in the U.S. where they manage $120 billion.
In less than 2 years?
Yeah, it's crazy.
I think
they just mopped up assets. I mean, Schwab is doing the same thing in the U.S. They launch a robo-advisor, and they just have such a big reach. They have so many clients that trust them.
So they charge 30 basis point fees. Fees scale after $5 million.
50,000 minimum. But the big
account
thing,
size, that's accessible for many, many investors.
Absolutely. But you look at Wealthsimple in Canada, they're charging 40 basis points. And to have advice, like to have an advisor, like you get with the Vanguard personal advisor service in the U.S., you have to have 100K. So you're paying 40 basis points on 100K to get the same thing that Vanguard's offering to their US clients for 30 basis points. Right. So if I'm Wealthsimple, I'm shaking in my boots. Same as any of the other robo-advisors.
And you can be sure that Vanguard's figured out the call center and how to organize the people internally. And we had heard from my friend in New York City talking about how much the financial planning talent that Vanguard is mopping up in the US. It's a huge talent drain, which is great for their clients. So
their pitch in the US, I went on the Vanguard Personal Advisor Service website and they said they get to know you, your goals, and your unique financial situation. And then they partner with you to create a custom tailored financial plan. And then they put your plan into action and manage your portfolio, allowing you to be as involved as you want to be. And they work with you to keep track of your plan's progress. They rebalance your portfolio as necessary and partner with you to revise your plan when important life changes occur. That's pretty sweet. That's more than you're getting with $50,000 from any of the robo-advisors. Well, most of the robo-advisors in Canada. Yeah. So yeah, if I'm a robo-advisor and I hear this announcement, I'm nervous. For us, firms like us, I don't think it affects anything any more than
awareness around this, which is good. Competition's good.
That's what I mean. That's not
competition. Our game.
Is it competition? Maybe for small clients? I don't know. Because the people that come to us want to talk to a human.
I'm just saying in general, in the marketplace in general, more awareness is good.
Yeah, it's good. Anyway, I don't think this affects us any more than Wealthsimple affects us. But I think Vanguard's announcement big time affects other robo-advisors that already exist in Canada with their relatively high fees compared to what's in the US. You sent me a survey on some active managers, and the title was something along the lines of,
It's just so ridiculous.
Institutions are losing faith in index funds or something like that.
Yeah, so it's a story that came across Twitter that I saw that might be fun to chat about. And I think you put a title on this as basically a non-story. So it's just amazing to me how institutions clearly are not aware of what the evidence shows. And there's so much, agency risk, agency bias that when you're paid to pick stocks, what are you going to do? You're going to pick stocks.
It was a non-story. The headline was, I don't remember what the headline was, but it was total clickbait. Let me see what the headline was. It was asset owners are falling out of love with index funds. So, okay, that seems pretty interesting. But
so
you read the article.
What does that mean? You're falling in love with capitalism? You don't believe markets work anymore? You don't believe there's fair information discovery and prices? How is that possible?
Well, here, I'll tell you what it means. It means you're clueless. Here's the survey results. 61%, so these are institutions, institutional investors who were asked to complete the survey through the Natixis investment managers. 61% of the respondents to the survey said, listen to this, they said active management outperforms passive in the long run. So okay, we can stop reading the article now because clearly it's full of information that is simply untrue.
And 4 out of 5 of institutional investors believe active managers will have an advantage in 2019.
Yeah, no, it's ridiculous.
Based on what?
I know. Anyway, it was a non-story. I thought it would still be fun to talk about, but it was completely ridiculous. Here, listen to this quote. I copied this quote. Quote, "It is likely that they want a skilled investment professional at the helm during these more turbulent times in order to identify opportunities created by higher levels of dispersion and generate better returns overall." That is what the Natixis survey report concluded. Anyway, it's completely ridiculous, but whatever, fun to talk about, I guess. But you're right. It is crazy that institutional money managers, that a majority of them would say that active outperforms passive in the long run when there is such strong data refuting a statement like that.
But you can see, I mean, times like these where the markets are bouncing around quite a bit, we've had a couple of cases lately where people have chosen to move their money elsewhere to do something. They feel the need to do something. They feel the need. They've seen other people have success choosing stocks, and they feel, given what's happening in the marketplace, the markets are different, or whatever excuse you want to make, they've made choices to invest in stocks somewhere else, individual stock picking. So that need obviously just goes all the way through to the institutional world as well. It's no different. People are people.
It's the bias for action. I always remember what Shane Parrish said when I interviewed him for the podcast. He said that the two most harmful biases, I hope I remember this correctly, are overconfidence and a bias for action. It's a deadly combination when you add them together. Yeah. Anyway, that's it. You sent over a story about why aren't rich people happy? Like, why does more money not make people happier?
Yeah, I mean, it's an interesting little article talking about, when people compare themselves to others, which is often what people do. It's hard to know. The example they gave, like, how do I know I'm a better parent than my neighbors? So if you're going to compare yourself, it's much easier to choose something that you can actually see that you're better than your neighbor, depending how you define better. So I guess a lot of people do this by looking at their balance sheet. And if I'm wealthier than my neighbor, I'll be happier, is what they think. But the reality is, even the super rich don't get happier as they get wealthier. And this is something that Daniel Kahneman has talked about. Beyond $60,000 of income, we're not necessarily happier beyond that. My
biggest takeaway from the article was that it talked about how when you get extremely wealthy and you have everything that someone that's not wealthy could possibly have, then you just start comparing yourself to everybody else. So it's like, as you're trying to accumulate wealth and have more and more, you think you're going to measure happiness by the stuff that you have. And as soon as you have everything that you could possibly have, you start measuring how much you have relative to your other rich friends.
But I think a lot of people do that, whether they're super wealthy or not.
Yeah.
Because it's easy.
Yeah. And the human adaptability, like you can never have enough unless you make the decision to feel like you have enough.
Right.
You'll never objectively have enough unless you make that decision yourself.
Humans adapt amazingly.
Yeah, it's all about perception. All right, ready?
Big question.
Okay. We had a listener question, which ties in really well with the main topic that we are so excited to talk about. So the listener question, and I paraphrased it quite a bit. It was kind of long, but I chopped it down. I think I still got the essence of the question, though. So they asked, I understand that indexing makes sense and that the majority of investors cannot beat the market, but I always hear you talking about factors as a way to beat the market. Shouldn't the higher expected returns of the factors be included in prices, eliminating any benefit? That's true. We do talk, it might sound contradictory because we talk about how people can't beat the market and we laugh at active managers and how ridiculous they are. But on the other hand, we talk about factors. So it's important, I guess, to explain why factors work. When we talk about factors, we're talking about investing in, for example, small cap stocks. So in the market as a whole, small cap stocks exist. When you own the market as a whole, you do have exposure to small caps, but only in market cap weights. And when you just have market cap weight of small caps, you don't actually have what we would call small cap factor exposure. You just have market factor exposure.
With maybe, you take in the US market, small caps might be
5%, small value.
5 to 15% maybe in total, right?
Small value might be 5%.
So it's heavily skewed towards large cap stocks, the market return.
So when we start talking about factors, what we mean is adding in more of a specific type of stock relative to the market. So if we're saying the small cap stocks in the US are 15%, it might mean adding up to 30% of your portfolio is in small caps. Now that 15% additional exposure to small caps, we'd call that factor exposure. So now you have small cap exposure in excess of market cap weights. Now, the reason the factors matter is because those types of stocks, so small caps in the example that we're working with, have higher long-term returns than large caps, but they also have higher expected future returns. Now, the big question becomes why? Because this listener question here, they're saying, okay, I get that, but if everyone knows that, isn't that priced in? And that seems like, yeah, it should be, because we always talk about market efficiency and things like that.
And I think most people, when they look at the overall market, they know there's going to be dispersion of returns. They know some stocks will have higher expected returns than others. What's debated is the reason for those differences in returns. And it's these differences that academia has been looking at for 50 plus years now. What is causing this dispersion of returns? And
so there are different explanations, two schools of thought. I only care about one of them. I think the other one is, I just don't care. But not that that's not fair to say. I don't like it. I don't know. So there are two explanations.
One is rational. That's why.
Right. You're right. That is why probably I don't like it.
The rational reminder.
That's why we're here. So the two explanations are risk-based, meaning small stocks or value stocks or whatever it may be have higher expected returns because they are riskier. Now, there are some pretty good stories to back that up just based on the economics of a small company or a value company. So if the assets are riskier to own, the cost of capital is higher, and the investor that owns the asset has a higher expected return because they're taking more risk. It's not a free lunch. They're taking more risk.
The investor's return is a company's cost of capital.
That's right.
If you and I set up...
Expected return.
Expected return. If you and I set up a small business this afternoon and went to raise money, the cost we would have to pay the investor is higher than if Walmart goes out and raises money.
Right.
Most people get that.
Yeah.
It's a risk story.
Yeah. The other story is behavioral. I don't even want to talk about it. I mean, people undervalue, I guess, small stocks would be the story, or they undervalue value stocks, I guess. Is that the behavioral story for value?
Yeah, they just don't, they overreact at times and just don't want to own them.
Right. That's what it is. I know the behavioral story for momentum. Well, it's the same thing, I guess. People overreact and underreact to new information. Anyway, I'm not crazy about the behavioral story, and the behavioral story for risk premiums has created a whole bunch of other ways of thinking about the evidence, which is what we're going to get into in a second. So anyways, to sum it all up regarding factors, it's a way to take more risk, but more priced risk. So we know that over the long term and all over the world and over every time period that we can slice up, small stocks outperform large stocks, values outperform growth. And we hypothesize, I guess, that is because those assets are riskier.
Right. And when you put them together in a portfolio, you increase the overall returns and lower the overall expected volatility.
That's where it gets really interesting, because value on their own are riskier than growth, or riskier than market. Small on their own are riskier than market. But when you start adding factors together, small is not perfectly correlated with value. Value is not perfectly correlated with market. Small is not perfectly correlated with market. So you add in, say, 3 or 4 factors together in a portfolio that have imperfect correlation, all of a sudden, even though you're adding these additional risk factors, they're diversifying risk factors.
Right.
So you're increasing your expected returns without adding potentially a lot more volatility.
But you are increasing your tracking error, meaning you will look different than the marketplace.
Which is a risk.
Which is a risk. How you will behave when you look different than the market. And we've gone through periods like that where we look great compared to the market. Other times you don't look so great.
And the end investor has to understand, and it ties right into the question from the listener, why would you pursue factors? It's because they have higher expected returns. Higher expected returns do not mean you're going to have higher returns all of the time. But over the long term, the evidence suggests that you should have a higher return over the long term.
And even if you go a decade without them, that's not unexpected. It's quite possible you have a decade where small does not outperform.
Statistically, that is very possible. Okay, so I hope that answers the listener question. We're saying that factors are additional risks that you can add into a portfolio. So yes, it seems like we're talking about being able to beat the market, and it sort of is true, but it's just adding in targeted risks to a portfolio. And
also, too, you can go and do factor loading on other portfolios. If you found an active fund that has beaten the market, often if you go and do factor loading, which I know you've done on portfolios.
Factor regression on portfolios, someone outperformed the market. Well, you can go back and see, well, it's because they had an overweight in small or an overweight in value. Well, it gets really important with benchmarking. So it's like what Cameron's talking about. If we take a U.S. equity fund manager and they've generated alpha, so they've generated higher risk-adjusted returns than, say, the S&P 500, benchmarked against the S&P 500. If we go and run a regression and it turns out that fund had a whole bunch of small cap exposure, their risk-adjusted alpha, if we add in small cap, may be 0 or maybe negative. Mm-hmm. So while it looks like alpha when you compare them to the S&P 500, as soon as you compare them to a small cap index or some blend of the S&P 500 and a small cap index, all of a sudden they didn't generate alpha. They just held more small cap. Anyway, so that whole factor discussion is one of the reasons that it's become so much more challenging to generate alpha, because alpha can now be explained in a lot of cases by beta or by risk factors. Okay, but we're running out of time. So I do want to get into this topic that we wanted to talk about. So something that's happened this year is that AQR, which is a firm called Applied Quantitative Research, AQR, founded by a guy named Cliff Asness, who studied under Eugene Fama. Now, Cliff is brilliant and has produced a massive amount of helpful and fantastic research. Mm-hmm. AQR has been having a lot of trouble this year. Now, that's no fault of Cliff. It's no fault of AQR. It's not a knock against their company at all. What they do is fine, but it's happening. So they've had serious performance issues. Now, this gives us a good opportunity to talk about a question that we get every now and then. So AQR is a firm that apply, like the name says, they apply research, and they use fantastic evidence. They use the same kind of evidence that Dimensional uses. They use some of Fama and French's work.
And they're a $200 billion plus firm.
226,
so
they're huge.
Serious firm. And in this space, they're a large player in this space.
Huge in the quant investing or evidence-based. Well, I don't know if you group them with evidence-based investing, but the fact is they are using evidence to build portfolios. And that sounds like what we do here at PWL or what Dimensional does. So we occasionally get questions about why is Dimensional not following this research that AQR is talking about? Or why are you guys not using AQR products and instead just using Dimensional? Like, why are you choosing to follow that research? We'll talk about what AQR builds. So their core products, I think, are what are called liquid alternative beta. What that means is it's like alternative investments are like hedge funds or private equity. Those are not liquid. Liquid alt beta is an attempt to create an alternative, so an uncorrelated with equities or fixed income, an uncorrelated asset class that is liquid. So unlike a hedge fund with a lockup or a private equity fund with a lockup, you can buy or sell the fund anytime. It's perfectly liquid. And they do that by going long and short. So they'll own stocks and they'll short sell other stocks. What that does is it takes away their correlation with the market.
But it's not negatively correlated.
It's uncorrelated. Right. Uncorrelated. So they take away market beta. So you're no longer exposed to market beta. You're exposed to the long short portfolios that they build. Now,
my point of being not uncorrelated, but not opposite correlation, because markets are down this year, they're not up this year.
Right. So it's not a negative correlation.
It's not a negative correlation. That's my point.
Yeah. And Cliff makes that very clear. So Cliff wrote a big long letter to investors because they're doing so poorly this year. But there were a couple of great quotes from that I pulled out. So Cliff explains why you would want to hold liquid alt beta. So he says, you do not want a liquid alt because you're bearish on stocks. This is kind of like what you're saying, Cameron. You do not want a liquid alt because you're bearish on stocks or traditional assets. That kind of timing is difficult to do well. Plus, if you're convinced traditional assets are going to plummet, you want to be short, not alternative. In other words, liquid alts are a diversifier, not a hedge. You should invest because you believe that it has a positive expected return and provides diversification versus everything else you're doing. If you can add an asset with a positive expected return that's not correlated to the rest of your portfolio, it makes your portfolio better. That is true.
Kind of like what we were saying about factors earlier.
It's very similar. You can achieve for the same risk a higher expected return. This is through diversification, or the same expected return with lower risk, or you can improve both. That's all true. That's all true. That is all true of liquid alts. They may improve the characteristics overall of a portfolio if we're talking about things like correlation and standard deviation. So it is evidence-based. Now, this is where it's different. Well, they're following evidence, so they're long and short based on factors. That sounds like a good thing. But AQR is building long-short portfolios by selecting individual stocks based on the factors. So, okay, now we've added in a whole other element. So Dimensional's total market with a tilt towards small cap and value. They're not picking stocks. They're not using factors to select individual securities. So already AQR is doing something very different. And sure, it's evidence-based. I don't disagree with that. And I would never tell Cliff Asness that what he's doing is not evidence-based. So here's another quote from Cliff. As a blunt example, in general, we believe in choosing, listen to this. It's crazy to me. As a blunt example, in general, we believe in choosing individual stocks with good value, good momentum, both price and fundamental, low risk, high quality, example, profitability and margins, and positive views from those we think are informed investors.
Sounds like a no-brainer.
Geez, it sounds like an actively managed fund.
Of course it does, but it sounds great.
And then he says we like to underweight or sell their opposites. I mean, that's very different from being in a long-only total market portfolio with a slight tilt toward size and value already, right? Like we've added a whole other element of security selection and long-short. If you're long and short, that means if what you think is going to do well does poorly and what you think is going to do poorly does well, which is probably what's happening this year, you get hit on both sides. Right. So you'll be down twice what you would have been down if you were just long or just short.
How did he defend this stock picking?
Well, he tied back to evidence, right? Well, we're picking stocks based on these known factors, which, I mean, I get it, but I guess it's way more aggressive than DFA or Dimensional. It's like taking what Dimensional is doing and jacking it up in a huge way and taking it to the absolute extreme.
But their long short fund is down like over 15% so far this year.
Yeah. Well, so they say, I was reading one of the prospectus of the funds and it says, long short equity fund returns come from 3 independent sources of return. Equity market exposure, which is beta, which we have exposure to as well in our portfolios or in Dimensional's portfolios. The return from tactically varying exposure to beta. So now that all of a sudden we've added this whole other element where it's like, okay, we're not just going to get passive exposure to beta, which is what Dimensional aims to do. We're actually going to tactically vary exposure to beta based on our outlook for the market. Huge difference. And then the last one, and this is the one that blows my mind, is long-short stock selection, which is pure alpha. So now all of a sudden, we're not just getting exposure to factors. We're not just getting exposure to market beta. We're getting varying exposure to market beta over time. And we're betting on alpha.
It would be neat to unpack the returns to see, based on those three sources, where the returns came from.
I don't know how what's long short.
You never do it, but it'd be fascinating to see if it. I mean, my gut is that the long short stock selection may have been the culprit, but we don't know. It'd be really fascinating to see that.
Well, it's got to be. Either way, the strategy's blowing up. So another quote from Cliff: applying these, or I don't know if this is from Cliff or from the prospectus actually, but applying these and other proprietary indicators, we take long or short positions in industries, sectors, and companies that we believe are conditionally attractive or unattractive. The result is a portfolio that seeks positive absolute returns with close to zero equity market beta. Okay, so that's liquid alts. It's like a different asset class created by messing around with long-short portfolios and stocks and bonds based on factors. And yes, you do eliminate exposure to market beta, which some people like because it does give you an alternative asset class that's potentially diversifying. Okay, now why do we not use these strategies? First of all, they're expensive. You look at AQR funds, all of the fees, over 2%. Now,
higher turnover?
Much higher turnover.
So turnover is buying and selling the shares inside the portfolio each year.
And inherently, it's going to be higher turnover because stock characteristics change. And when you're long short, you'd have to change your holdings, I guess, relatively frequently, especially compared to a long-only portfolio like Dimensional. So I just looked at their year-end distribution. So their long-short equity fund, which is the one that's really gotten hammered this year in terms of performance, it's also going to have an estimated year-end distribution of 3.6%. That's a big distribution. Not only are you getting hammered on performance, you're also getting this big distribution from high turnover. Now, some people would say, well, a fund like this, you would hold in your RSP or TFSA. Fair enough, I guess. But then you're also risking the RSP or TFSA room for this alternative strategy. Anyway, yeah, so it's just a totally different perspective on implementing factors. It's like, okay, instead of using this long-only strategy to get enduring exposure to the factors that we know have higher expected returns, we're going to kind of mess around with individual stocks, using the factors as, I guess, a basis to do so. Yeah, so like you said, Cameron, their long-short equity fund is down 15.71%. Their managed future fund is down 14.44%. Global equity, long only, like a Dimensional global equity, is down 7%. So these alternative strategies are down twice as much as the equity market when the equity market's down, which you can't say that you would expect or not expect that because the alternatives are supposed to be uncorrelated, not negatively correlated. So it can happen sometimes that both are down at the same time. One of the things Cliff wrote about in his letter to investors was, when should you change your mind? We've had that question from clients too. Like, we're pursuing small value profitability. At what point do you change your mind? How much evidence do you need? And Cliff's answer was great. Cliff's, everything he says is accurate and intelligent and rational. Just their strategies are way more extreme than anything that I would want to touch. And we talked about behavioral earlier. A lot of their strategies are based on exploiting behavioral biases. Anyway, so Cliff said, one should change their mind based on evidence, which we agree with, obviously. Big enough numbers to change the long-term historical evidence or a theory going forward that is supported by observation. And Cliff is saying none of those things are true. Nothing's changed. Therefore, our strategy should still work going forward despite this period of really bad performance.
And to bring it back to our world, I guess in our world it would be like someone coming to us and saying, why don't you guys put all the portfolio into small cap value? That would be the highest expected returns out of all the different asset classes based on the evidence.
Well, long, small value and short, large growth.
Yes, if you could short, but yes.
But we would never do that because it would be crazy volatility. And one of the things Dimensional always says that I love is if it doesn't work out, if the factors don't work out, you're still going to get a pretty good result, right? Because you're still total market. You're still betting on capitalism. That's the main basis for your bet is capitalism.
Because remember, these models aren't reality. They're a model of reality to try to understand reality. And you never know what kind of risks are out there. And Gene Pham, every time we see him, always highlights that. Yep. This is a model. This is not reality.
That's right. The map is not the territory. Anyway, so AQR's had net outflows this year of $3.5 billion, which is a lot. I mean, maybe not that much for them, but it's still a lot for any company. That's as at the end of October. About half of those outflows were from institutions and about half were from advised retail accounts. So AQR, similar to Dimensional, they only distribute through advisors for the most part. And I don't know if it's worth pointing out. It's not. It seems like it's just a jab at AQR, but I was interested, so I looked up the number. Dimensional in the U.S., while AQR has bled $3.5 billion, Dimensional's had inflows of $20 billion in the U.S., and in Canada they've had inflows of $5 billion so far this year. And Dimensional they've had positive inflows every month, I believe, since inception. That data point may be a couple of years old, but I doubt it's changed. Anyway, but the main topic there was why do we not use liquid alt beta or other evidence-based, sort of more aggressive tools, I guess it's a choice.
Yeah, I mean, we're reasonably balanced. We don't want to be dead wrong for sure. If you go all small value, you could be dead wrong. Well,
if you go all liquid alt, or even if you have some liquid alt, I don't know. The story behind liquid alt, it just does not resonate with me enough. The risk-based story of small value resonates with me enough that tilting toward it without going full tilt seems sensible.
And people understand it. And they know that when you put a rules-based platform in place, it gives a certain fixed percentage allocation to all of these with regular rebalancing. People get it. People can live with it. We go out of our way to explain the expected return volatility so people can stay in their seat even though they might not look like the broad market.
You start adding in liquid alt with long, short, high fees, high turnover, it just changes the whole ballgame. Even though, I don't know, it's an evidence-based strategy, and I don't disagree with that, but it's kind of pushing the evidence to the limit. Like, how far can we push this? Meb Faber has his Cambria funds. They do something similar. They take he's got one global value, I can't remember what it's called. It's a global value index fund, but they take the 25% cheapest countries and then select stocks in those countries. And yeah, I mean, sure, there's probably basis for that, and Meb Faber's probably written a paper on it. Does that mean that I would do it for our clients or for myself? No, because again, it's high turnover, relatively high fee compared to a dimensional fund. And you're timing the factors, which maybe there's evidence you can do that, but there's also evidence that you can't. Long only factor tilt. Anything else?
I think that's good for this week. We've factored people up.
All right.